Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, November 15th, 2024. It is 9:28 a.m. Eastern Time, so as I'm starting the video, we're about to have the opening bell ring, and I'm going to try to cover just the things I'm watching, some of the important things to watch, and I'm also going to follow up to some of the recent questions on the site. Watched the market yesterday. I was in and out from my desk. There just wasn't a lot going on. Markets have been kind of flattish, stalling out, and again, I just wasn't seeing a lot that was. I just wasn't feeling it, so I went out and got some things done yesterday. But let me do updates to the questions that were put to me, and I'm going to try to cover it roughly in this order. Start out, as I often do, with just a brief overview of the equity markets. And then I'll update, again, the things that I think are important to watch right now and or trade. You know, it could be trading ops, treasury bonds. NVDA was a question put to me, so I'm going to include that, but it's also a thing to watch as well. And on that, closely related is a SOXX semiconductor index. Gold, definitely. In that, I'm going to mention real quick, take a look at the dollar and the euro. Brief update for you on UNG. Somebody asked, just had a question about wheat, so I'm going to do an update on the grains, corn and wheat. There's opening bell for you. Time permitting, I'll do, I want to take a look at Bitcoin and Ethereum. And what else? Somebody asked about Netflix, and the only other question I think I haven't answered, somebody asked about, any update on market breadth indicators. It's kind of a lot. I want to get to that. Nothing glaring. It's just the same old there. And again, if I can't get to that in this video or hit on one or two, then I'll cover that in a second video for anybody interested. I would like to. There are some things I do watch them often, the market breadth indicators and various sentiment indicators that I follow as well. So that's a lot. We'll try to make it not super long. I just want to reiterate that there hasn't been any change in my longer term outlook for what are we? We're in mid-November, going back to late June. So in late June, I gave you this a market top range. I have not tweaked, edited, modified, touched anything on this chart other than maybe this uptrend line right here. Making sure it fits, and then the divergent high right here, added that. So going back there, it was before we got there. My market top range always ran from about 485 up to about 512. Again, only time will tell if that caps it. We came close to it there, had that correction, figured it was a first leg down. It was time to cover, so we covered that when T2 was hit right there, and the 200-day moving averages and everything else, expecting a tradable bounce, and that's what I think we've gotten. So again, from this longer term perspective, nothing has changed my outlook. And it could. We're pushing the upper limits of it. Remember, last week we closed right at the top of the range. This week we've been testing the range. You got to zoom in tight. This is a weekly chart. I gave this chart to you back on June 26th, and every copy of it since. I've had some on the week daily, but this is the weekly chart. And as I've and continue to maintain, when you're trading or analyzing off a weekly chart, all that matters is how the weekly candle closes. So today's Friday. It's 9:30. Just let's do some quick math. Here's where we're at right now. Opening bell just rang. We're down about a little over 1%. A push of, even if we reversed right now and gained on the day from where we're at now, from today, we'd have to reverse and rally about 2.5%. Still going to park us right at the top of the range. So barring anything huge, we're going to have yet another rejection here at the top of the market top range, which again, it gives me perfect alignment for the price targets I laid out back then and a lot of these key Fibonacci retracement levels. This is the 38.2, 50, 61.8. They went into, they weren't the sole determinant. My price targets, first and foremost, are support levels I think we're likely to get a reaction on. And that's where you have these next three here. And then all the better, as I often say, it never fails to amaze me once I first put my price targets in place, whether it's an upside long trade or a pullback short trade, how well and how often the key Fibonacci retracement levels line up. So T5 would take us down about a 61.8 retracement. My next target, remember, T1 and 2 have been hit. So those are checked. Whether or not I, will cover in reverse if we get to these levels again. There's still support levels. It depends, but I can just speak to right now. even myself, I wear multiple hats. I have an active trader hat. Sometimes I'm day trading in and out. Trades are measured in minutes or hours. And then long-term accounts, I can't possibly manage dozen personal family accounts, different brokerages, several different brokerages, logging on, logging out. So those are the long-term stuff, and these are the long-term targets where I typically won't at this point in time. If we do, again, there's a lot to be done, guys. We're pushing. Let me just say this: we're much higher risk of breaking out to new highs and then just foiling this market top range than we are at this point in time of hitting these targets. However, it is still my preferred scenario. It's what I believe will happen, and work to be done. But one of the big things will be to take out these 200-day moving averages. Again, we're looking at a weekly chart. So on a weekly chart, they're 40-period moving averages, but the same thing as your 200-day moving averages. And if those get taken out on a weekly basis, see right here, we tested them, cut through them intra-week, only to print back above. So it was a successful test of the 200s. Just like that was a successful test of the 200s right there. Okay, so there's your big picture, kind of long-term outlook. Near term, the last update I gave you mentioned that we still had, on all time frames, the significant time frames, 60-minute, daily, weekly, monthly, negative divergence on QQQ. And I think it was on the futures I was showing you here. Let me queue up the futures. Yeah, I believe it was earlier this week or last week. I said this level would probably do the trick, about 21,100. We were trading in that range, and so we got that was taken out. There's a sell signal. We just took out this reaction high, and again, so you can look near term. That was a divergent high. You can see the divergence steepened right here, and that's it. So bigger picture, if you're playing the long game, I'll still maintain, if you're going to give it some room, stop somewhat above the top of that market top range, ideally on a weekly closing basis, somewhat is relative to your targets. Let's look at the, while we're on NQ, let's look at the daily chart. So we start out with QQQ on the weekly chart. That was on June 26th. I first posted those targets in that market top range. And then I followed up on this one here. You can see on the bottom that was July 10th with NQ for you futures traders, and stating this is the actual chart. NQ comparable range right here, that shaded box. And I said I had an ideal market top. The top of the range was at 2100, and that was my ideal market top level, because 2100 would then give me the fib alignment I was looking for. And we went on to hit T6 to the button right here the morning of August. I'm sorry, that was I've got that chart here somewhere. There it is. All right, and that morning, that was our hard reversal. Full out, cover all shorts right there in the morning. Then I got followed up with this chart and looking for a bounce. And so that was a perfect milking from the highs to the lows, virtually to the penny, or within mere basis points. So that was then. This is now. Let's go back to the live chart right here. Let's get rid of this one. There's the live chart. And so that's it. That was my market top range. I was 2100 within basis points. We hit T6 to the button. Same targets have not been modified. I still maintain these additional targets. I think there's one more down below. I'm zoomed in a little bit here. And so what did we do? We came right back up to right about 2100, right around that ideal. The shaded box was drawn in before. It was right here. And so that's it. So, it's taken a while. I make a lot of terms and sayings up in the market, my own little versions of yogiisms. One of them is, if patience in life is a virtue, it is an absolute must in trading. Now, again, this wasn't anyone. Now, it could be for you. You may be, hey, I agree with these targets. I'm going to ride this out hell or high water. You could have shorted here, rode out this whole bounce. Again, I advised against it. Said there was just too many reasons to go long, cover all shorts there on T6. But this is it. So if it plays out as such, we're going to go down here. Let me step out to the longer term. Go 2 years. Yeah, there it is. There's my T9. So that's my current final target right there, which would be a 61.8 retracement. right there. So that aligns with that 61.8, the retracement on the QQQ weekly chart. And so we'll see. And again, like any trade, I've been covering this one quite a bit. It either pans out or not. So it's like any other trade. Don't put all your eggs in one basket. If it does pan out, there's T5 is comparable to that level there. They're not, these targets don't align. But T5 would be a 61.8% Fibonacci retracement, and that would align with the that T9, I think it was, I just gave you on the futures. Okay, enough on that. Let's just see how it works out. And again, ideally, we need to pretty much, have topped on around this week, last week, or at least not go much higher. Again, these calls are price calls; they're not timing calls. I never laid out when, expect, because that's the one thing you don't know. And that's, I've said many times in the past, that's why I'm not a big options trader. It's one thing, difficult enough to call with precision where a stock or an index is going to go. That's where my skill set lies. It's a whole nother infinite degree of difficulty to call exactly when it's going to get there. And that's what happens if you bet with options here that we were going to go down here and it was going to be, something like this. Then your options expired because we did this. We're back to where we started. But, if you, let's just say shorted QQQ and you're not messing around with leveraged ETFs, which would have decayed, and you would have, actually, even if QQQ is right back to where it started, months ago on those leveraged ETFs, you would have lost money due to the decay. And again, I explained that in the FAQ section on the right side of the chart under ETF related questions if you want to know how that works. All right, let's move forward to treasuries. Let's just go to the 10-year yield. Most important bond to watch, the 10-year. So this is, I have different boards here. What you can see here is this is I'll just kind of recap the yields. This is a long-term chart, goes back, a monthly chart. This goes back into the 60s, early 60s right here. And we had a period of a secular bull market in rates, meaning rising rates. Within there, you had your corrections along the way, like any bull market. This is where rates peaked way back in the early 80s. And then we entered a secular bear market with falling rates. And it was a nice controlled price channel. And then you had the bouts, these big downs here are massive intervention, artificial manipulation. This was natural forces, in my opinion. Bull and bear markets, sure, the Fed has every hand, but this is where the Fed just figured out we can just keep, printing money, messing with the markets, intervening, quantitative easing. So you had these big drops through the channel, ending with the all-out nuclear button they hit, when COVID happened, with both fiscal and monetary stimulus, and then boom, and that's it. So I've maintained emphatically for a long time that we've most likely that secular bear market in interest rates has ended, which will also mark one of the greatest secular bull markets in history. This is Economics 101. This is not my opinion. It is fact. Falling rates are stimulative and bullish for both the economy and the stock market. Obviously, lower rates lower the cost of capital, so companies will start more projects. Easier to start a company, build a new facility, production plant, whatever it is you're doing. Buy a house, buy a car, a boat, and then so there's that. And then the other part of it is the alternative, and the alternative to equities. And because people and Bernanke himself and other Fed chairs have stated this, but clearly that one reason back in the financial crisis and since they did quantitative easing and lower rates was to force money into stocks to support the stock market. Because when you take yields down to next to nothing, who wants to lock your money up for 3% for 30 years in a Treasury bond or less? When you can, get a maybe 10+% in the stock market, especially when its stock market's doing very well. So we know that's just it's as old as the hills. That higher the rates go on safe, guaranteed investments like Treasuries, it's an incremental but steady shift where more and more people, especially institutions, think that where a lot of the money is parked, pension funds, things like that that have obligations. Why risk to maybe make an annual return in the stock market of 10, 11, 12% long-term returns when you can lose in any bad year, given bad year, 50% or more? History has showed us that, where you can lock in. That's the thing about treasuries if you hold to maturity. So this will, over time, and it's not an immediate thing, but over time as rates go up and remain higher, if we do this, then yeah, it's going to be, it's going to be net positive for the stock market. If we have embarked on a new secular bull market, which I believe in interest rates, however it plays out, even if we back test the channel, be near-term drop, that will be longer-term bullish. So don't think about this, trades. We don't have any trades bet right now or laid or we're in based on where I think interest rates are going to be 5-10 years. I'm just sharing my opinion. So, but we are watching these on a closer time frame, and we've been threading the needle pretty damn good on treasuries for a long time now. And so this is it. So on the 10-year, it's a busy chart, but just to recap, we're at this downtrend line off the highs. That's the highs back here in October of 2023, right there. That peak in yields. There's a nice reaction there, and we hit that level again. So we hit it right here. We're back to it now. So what we're seeing here is we're still weeks ago. Remember, I've been talking about this for a couple weeks now. We're at resistance. We'll probably get a reaction, but so far we haven't. And I am completely open. I still don't think it'll happen, but I think it could happen. In other words, I might be like 60-40. I'm not, 100% that we have to pull back here. If it does happen, that's going to just break the stock market. If we pop here, especially pop that high, and we get anywhere near this high, it will reaffirm that the Fed has lost control. Remember, these are your rate cuts here. Fed cut 50 basis points. Everybody, well, not everybody, not us, because we went short treasuries, which is long yields. They move opposite. And I expected this to happen, but most thought that it was going to do this because the Fed cut 50. Then they cut 25. We had a one-day little pullback, and rates snapped right back up. So far, and the longer this goes on, especially, there's two components. I've talked about it quite a bit. There's the time element and the price or yield element. Okay, it's a function of the two, really. Yields remain elevated. We're not far off those previous highs. And there's that whole debt maturity wall. A lot of companies refinancing or will be refinancing within the next year or two. And then on IEF, I gave you the zones, color by numbers, right? Or paint by numbers or whatever it is, color by, what we call it trading by colors here. Let me grab it here. It's just this right here. The zones I gave you back earlier in the year, I created these zones back in green zone February of this year. So, and they worked very well back then. I warned that, the yellow zone was where the stock market would start to take note of rising yields, but just take note. The orange zone is where it would really start to take note, and it did. We entered here and here. Both times we entered, we had pretty good corrections. And then we had the, the market corrected, started correcting back in June into the August lows. So treasuries went up for a flight to safety bid. And so that's why yields dropped. But you can see this, yields have been going up. And again, it was technically induced. So, forget the bobbleheads on TV that are talking about why rates are going to do this or that. You'll go broke trying to trade fundamentals and reason and logic for interest rates. The only way to trade bonds, in my opinion, are by technicals. So right now you can see a price channel. You still have the positive divergence. By the way, this was a question somebody just asked. Yeah, the case can still be made to go long bonds. Like any trade, you don't put all your money in it just because you have positive divergence and you're at resistance on yields, which is support on the treasury bonds. You can make a case to go long. You'd want to see a breakout above this downtrend line on IEF. Again, this is just a 10-year. You might want to trade the 30-year. You get more juice. There's the downtrend line right there. And you can see we haven't broke it. We had one intraday false breakout. It wasn't even a failed breakout because it was just an intraday move, and that was right after the Fed. So this is the downtrend line, guys, to watch. And when we break this, if and when we break it, and if we do, it can come, if it comes in the form of the stock market going down, that'll be a flight to safety bid. It's still a trade to be made. And see this, I've been talking about this for a while, waiting to see a bullish PPO crossover, low level. We still haven't got it. Look how the PPO is just flattened out here. So bonds should be bouncing. The IEF, you can see it's coming up. I've got some support down here. Just watch that trend line. And there's the uptrend line, which is just cracking below, but yet I just showed you. Actually, the TNX has a slight delay on it, so we might be breaking out here. We'll watch it. Again, guys, it's something to watch. You can trade it. You can use it as an indirect hedge to equity short if you want. There's a lot of ways to do it. But when you get the low-level bullish, PPO crossovers, that usually helps to confirm a trend change. And again, it's been pending for a while, but it just hasn't happened. You can see we had a little whipsaw around the Fed. All right, so that's it. Anyways, something to watch, guys. Something to watch, something to trade if you want. Another question, when's the stock market, when are we going to have a good sell signal? Somebody asked about NVIDIA, and this is everything now. This is the stock market. I've been saying that for a long time. It's not being literal, but it's the single most important stock, right up there with Apple. It's even bigger than Apple now, I believe, market cap wise. Let me look here. It was the other day. Yeah, 3.6 trillion versus Apple's 3.4 trillion. And again, it's the psychological importance. And I've given you long-term targets. I gave you those back on June 26th when I gave you the targets for the market. We already hit my first target. We covered there. It was the 200-day moving averages were hit and the price support. And I still fully maintain these much deeper. This is still my final target here. Let me throw up the fibs because that's one thing I haven't done here. I'm going to put up the Fibonacci retracement. Oh, no, there's fibs. Yeah, they're right there. I need to make them a little brighter. And let's just see where they line up for kicks and giggles because I haven't done this in a while. Okay, 50%. Yeah, there it is. T1 was already hit. Now was the 32% retracement right there. Actually, that was from, we had the high was right there. That's from where it is now. So to come back to T1 again would be from where we're right now. If we get a sell signal, that'll be a 38.2 Fibonacci retracement. My second target aligns with the 50% Fibonacci retracement. The 61.8 is right here, but I don't have a price level because I don't have a price target because I don't have any support right there. This is T3, and then T4 aligns with the 78.6 perfectly with the 78.6. And that is still my final target. And that's going to entail, if it's hit, NVIDIA is going to drop about 72%. Most think it's heresy. They probably thought that, when I called the SMCI down to where it just hit to almost to the button. Oh, by the way, that stopped out, guys. That hit the, I think that hit the stop yesterday. And so, yeah, it's now below support. But we called that one down, shorted here first, then there, several other shorts all the way down. That was my final target right here, T2. We hit it. And so, I don't think NVIDIA will drop as much, but I see the same thing, something similar coming in NVIDIA. That was about an 80-something% drop. Okay, so, and again, I cannot overemphasize the importance to the stock market when this goes, and it's this purple trend line. Before then, you've got this near-term minor right here, this white uptrend line. That probably bring us down there. Then the purple trend line goes, especially on a weekly. That's where I gave you these initial downside targets. We're practically, virtually right where we were back when we peaked back then. And that's it. So watch Treasuries, watch NVIDIA, watch obviously the market itself. Those are the big things to watch. Semis are singing a different song than NVIDIA. So NVIDIA is a one-trick pony, and that just doesn't ever last. In business, and you can't keep having these super duper, bionic chips that everybody wants and no one else. The Chinese are making, and the Chinese are pretty damn good at reverse engineering stuff and figuring it out. They're pretty technologically savvy. So it's only a matter of time before they and others start making other, chips that are competitive and will take away from NVIDIA's dominance in the AI world. And again, to me, it's been priced. And look at this is the semiconductor sector. So if you strip out NVIDIA as a top component here, you strip out NVIDIA and the semiconductor sector is way down. And this is just like market breadth. This is just like, again, probably have to do it in a separate video, but I've looked at the performance. We know this, that the equal weighted Nasdaq and S&P has lagged the regular Nasdaq 100. You look at things like that, and it shows you fewer and fewer stocks have been holding the market up and doing most of the heavy lifting, and that's very, very much the same in the semiconductor, the SOXX semiconductor index. Again, if they had an equal weighted, or if you stripped NVIDIA out, but I just wanted to cover this. It's now triggered that sell signal. Remember, I've been highlighting this trend line here. Look at that, boom, 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 boom. We just broke down today. There's a sell signal. We're below the 200-day moving averages. Now, sometimes SOXX will punch through them a little bit and then regain them. It's simple. The further we get away from here. So what I want to see, I'm still looking at a potential head and shoulders stopping pattern here. This being, here, let me draw it out for you. We have a downward sloping neckline like this, a left shoulder there, a head, a complex head and shoulders pattern too. You can do a upward sloping trend line like that as well, the neckline. And then you have a complex head and shoulders pattern, has either two shoulders on both sides, or you can have double shoulders on one side, and that's probably what this would look like here. Again, you can look those up. Google complex head and shoulders pattern, you'll see. And the necklines can be sloping upward, downward, horizontal. So there's that, and maybe it's a head and shoulders, maybe it's not. I don't want to force that. What it is, or that doesn't make sense, but what is certainly a thing is this uptrend line right there. Hard to miss. And again, we've broken that today. We'll see if there's follow through. I suspect there will be. This is SOXX on a weekly chart. So, hey, you want to play it safe? Wait for a solid weekly close below there, because you can see right now, today's Friday. 1, 2, 3, 4. We're right on this trend line as I've drawn it here on the weekly. And then you can see that head and shoulders pattern actually looks pretty clear here too on the weekly right there, with the left shoulder, head, right shoulder. Neckline would probably be either horizontal. Yeah, you could do a horizontal neckline like that, something like that. All right, so and what you want to see is this right shoulder finalize on increased volume, which is what you'll get if the trend line breaks. Selling, you usually see more volume come in on selling than you do on buying. And where to? I'm going to move that. I'm going to borrow that line, probably take it down here. First stop about 179, and then ultimately we'll come in and check probably the secular bull market uptrend line. Comes off the late 2008 lows. Hasn't been checked in a while, and needs to be. Even if the semis, which remain in a big secular bull market, you have these cyclical. These are cyclical bear markets within a secular. That's your long-term secular bull, and even these cyclical bear markets are, you can see about 30, 40, 48%. So this one, just to come and check the trend line, which is still longer-term bullish if we hold, is a 43% drop, and that's right in line with these others. So I don't think my calls, I know some people think crazy semis. I just saw Citigroup, somebody pounding the table on the semis, thinking that it's a time to buy and the correction's over. We'll get into it now, but I pulled that their analyst. They have a key analyst that heads up semis, and I checked his calls against SOXX. I kid you not. And you can do the same. I forget the guy's name. He was all out bullish there. Started getting bearish right here. Of course, pretty much bullish all the time, except bearish when it's time to be bullish. Most analysts they're inherently bullish, and it's great. If you're going to be an analyst, better to be a perma bull and just about anything the perma bear, because stocks go up most of the time, but you get wiped out if you're telling your clients buy here, and then you start getting bearish there and putting sell and neutral ratings and all that and holds, when you should be going to getting bullish there. I swear to you, you can, again, Google, pick most of these analysts. And when you do a Google search, it's easy to do. Just go to the time parameters, put that name, put the name of the analyst, and then just go into the more settings under Google search and select a custom time period. And then you can easily see around tops and bottoms what were their calls. And then you can decide whether, and there are some good analysts out there, don't get me wrong, but 99.9% are just pretty much permanently bullish on most sectors they cover. It's the nature of the Wall Street, and that's really my background's there. I'm not an analyst, but a former stockbroker, and can tell you that it's just the machine of Wall Street. And it's great for investors, buy the dips. But one day, guys, again, and it will be, I believe, in the coming years here, this great secular bull market in equities, which coincided with the greatest secular bear market in interest rates, will have come to an end. And then you're going to be looking at something like Japan's lost decade. Google that, look at the Nikkei, go to the last, look at the last 20, 30 plus years of the performance of the Japanese Nikkei index, and then read about their, how similar their real estate bubble and everything bubble, and then quantitative easing, which they did, zero interest rate policies, see how that worked out for them. And that's more, we're on that path where it seems like we're set 20, 25 years behind them, both from a technical and a fundamental perspective. So I would encourage you to look at that. And the big takeaway is, so we'll do this swing trading day to day. I'm long or short based on 60-minute charts, daily charts. I watch a weekly, but longer term, you might want to keep that bigger picture in mind if your time horizon is only 5 or 10 years. Because the outlook for equities based on everything, including technically, in my case, that's what I'm making, but fundamentally with valuations, the return, risk reward outlook for equities is abysmal at this point in time. One of the worst in history. You can see many metrics out there telling you that. So we got to watch for these sell signals, and then that's it. And then we'll get the next leg down in a big bear market and make a lot of money shorting it. Alrighty, next up is going to be, let's do an update on gold. All right, speaking of something everybody and their brother was bullish on, but I've been warning about this big divergence. This is the daily chart. There was a sell signal there. We had secondary sell signal. Now we've clearly taken out that longer term uptrend line right there. After that big divergent high, give you targets back here. These targets I made on, let's see, October 23rd. So October 23rd right here. Yep, that's right. In a video I laid out here with sell signal come. We eked out a marginal new high, then took out the secondary trend line, hit the first, second, third. Oh, got to move that. Fourth, we're on T4 now. Again, that was created back. I just moved it on 925. T5 right there. So gold looks like a little more downside, and that was the final target I gave you back then. But we're below that trend line again. Be careful there. Silver, let's see what silver's doing. Silver, these were targets from back here on that previous one. Silver's actually diverging here. Some bullish divergence. Looking a little better, but it only goes so far without its big brother gold. But what I'm going to do for you here, and I have it on the futures, and we broke out on the futures. I know bullish falling wedge pattern there with positive divergence. So, and I want to show you the euro. Euro's at support. It's gotten the snot knocked out of it. So, yeah, I'm warming up the silver here. Gold, I can see maybe a little more downside, maybe not. I wouldn't short it here. Again, that was laid out back then. The bulk of the initial drop is, I think, beyond us now. But longer term, we broke that trend line. I want to look. Here's the 60-minute chart of SI silver futures. So that just broke out there. Again, how far it goes will depend on where gold goes. This is a 6-month chart of gold. 120-minute candlesticks. There's that uptrend line. It's been broken. So you got to be careful here. Yes, positive divergence, but we're coming off that big divergent high right here, and then that bearish rising wedge broke down, sent it gold down. We bounced on the trend line as expected. I highlighted that last week. We got a reaction, but it was very muted, and right into the first resistance level, got rejected. Now we're below the trend line. So my guess, some upside here. We may come in and back test the trend line. Let me show you the euro and the dollar. And then I may truncate this video and get to the rest of the stuff later, because I realize there's so much I want to cover. So EUR USD, remember this, that gold moves positively correlated to the euro because the euro is opposite the dollar. The reason the euro is the opposite of the dollar, because the dollar index, as we talk about, is an index. The dollar only goes up and down, not in a vacuum, but relative to other currencies. The euro, by far, without even a close second, is the biggest component of the dollar index at 57.6% weighting in the dollar index. The yen is only like 23. That's next. Everything else you add up doesn't even matter. You can put in the pound, Swiss franc. They just don't even move the needle, compared to the euro and the yen. So that's what you just watch the euro. Here's support. I don't know if you can see it. I have a blue line there. There was a support. We're coming off that big divergent high. This was bear. We had a breakout here, that primary downtrend line. We rallied, put in a divergent high, and then the euro got the snot knocked out of it. And that's what that is the dollar rallying. The dollar, you can look at UUP, the dollar, ETN. That's a major reaction high. There was negative divergence, little wedge, sell signal there. We hit this uptrend line. We hit it again. So this is the bull market uptrend line right now for the dollar. The dollar is very overbought right now. You can see the RSI with some divergence on the RSI. No divergence on the PPO, but so the dollar's limited. So the dollar's probably going to pull back. And remember, guys, I highlighted this. I highlighted the recent big plunge in the euro and the big rally in the dollar and told you there was almost certainly going to be a mean reversion. And it meant one of two things or a combination thereof, that the euro would and the dollar would pull back and the euro would rally, or gold would go down and play a game of catch up. And that's what it did, because remember, gold moves inversely to the dollar. And you can see here, if you don't believe me, if you want to check it yourself, you can put it right there. This one doesn't do it well. I like it on EUR USD better. There you go. This is a long-term chart. We're going back to 2022. And so when you look at the euro US dollar pair, you can see they're very, very tightly correlated. And again, it's simple. It's mathematics. The euros, the gold we're trading is priced in US dollars. So if the dollar is going down, it takes more dollars to buy an ounce of gold. If you freeze supply and demand, there's a perfect correlation or inverse correlation between the dollar and gold. And then what happened, this is what I pointed out here recently, that the euro was plunging, yet gold was going up, and I said that was unsustainable. And so you can see there's the mean reversion. And I said it could be a combination thereof. You could see even there was a rally, and they both came together, but then you had this next leg down. So this is why, so if you're wondering why your gold mining stocks and your silver and gold, again, it was priced into the charts, but this is it right here. And again, so no matter how much this is, you can have at times, and this is why you get the disconnects, when there's an unusually strong demand for gold, meaning a lot more buyers, it can offset that impact of the currencies. But either way, now the euro is extremely oversold. The dollar's overbought. You're probably going to have a rally here, so I wouldn't be shorting gold at this level, even though you are below that primary trend line. But you also have to be careful about going long. It may only bounce so much. It's maybe a trade you just want to maybe lighten up, put your stops in place if that's your thing right now, and or sit back and fry some fish that look better elsewhere. UNG, natural gas, had a pretty heavy down day yesterday, but it still looks fine from a longer term perspective. This is the ETN right there. You've got the primary downtrend line. I take this with a grain of salt because, over time, it's not going to track as well as actual the futures or natural gas prices, because this ETF has expenses and fees. So over time, you're going to, even if natural gas prices, let's just say hypothetically, stayed flat for 2 years, you're going to lose money in this, just kind of the way you'd lose money in a leverage ETF that's, grinding with the sectors going up and down, back and forth. So I always like to look at the charts of natural gas futures as well and trade those. Personally, that's what I trade. And so this is it, the continuous contract natural gas futures. And nothing's changed in the longer term outlook. I've been highlighting this divergent low right here. Big positive divergence right here, which is bullish at the recent lows. And right now, so that drop yesterday only took us down right here. I've been saying we have to pop these recent highs right here. Remember, we had a 113% rally off this divergent low, and I've highlighted on this chart, I've been covering this for weeks, if not months now, the previous divergent lows, and this goes back a while here. This is a weekly chart, weekly candles. We're going back to 05. 563% off that divergent low, 208% off that divergent low, 234, 158, and 222, right? And you can see the same thing on the divergent highs drop. So this is, as a long-term trader, I'm saying this is, we're probably about halfway to what, at minimum, what I think these divergences project, and that's probably bringing us up here to about $5. So we're still looking at almost a double, almost 100% return from where we're at now. But remember, we've been buying it here, and so just go back to the futures, shorter term now. Right here, I've been showing you a 6-month chart with 2-hour candles. There's the divergent low, and we just put in a divergent high, and this is it. This is how you just swing these divergent lows. Rally, divergent low, rally, divergent high, drop, divergent low, rally, divergent high, drop, divergent low, rally. And we recently put in a divergent low. It shows better. 60-minute charts usually my go-to swing trading time frame right here. And that was it. So we put in this little divergent high right here recently on the 60-minute chart, which is also that was a target I gave. That was resistance. About almost $3 right there, $2.98. And I said we need to clearly take that level out. We didn't clearly take it out. We just had a brief pop. I'm trying not to move the line. And that's it. And it sent us back down to this support. And it's in an uptrend. As long as we can hold this level, 1, 2, 3. So far, we're making a series of higher lows and 1, 2, 3 higher highs. So ideally, we don't always get what we want, but I think this is probably, we'll start the next leg up, and then we'll pop that level, and we'll go up here, have a reaction there, and then keep zigzagging up. So from a longer term perspective, nothing has changed, and still looks good. Okay, as promised, somebody asked me about wheat. Is wheat ever going to catch a bid here? I think so. Longer term perspective is still, wheat's still at, look at this long term support. This is the ETN, WAT. Still big positive divergence. Broke out here, back tested, and still above the downtrend line right here. You can see there's the primary downtrend line, bullish falling wedge, breakout back test. Just can't catch a bid. We get these little ups, we hit these little early targets. T1, T2 hit, we reverse shy of T3, and that's it. We still have positive divergence. We keep making these marginal new lows, and then boom, we pop. So looks good from a longer term perspective, in my opinion. Let me show you one other chart. Okay, this is my long-term chart. This is a weekly chart, weekly candles of wheat futures here. This is a secular bull market uptrend line right here. We're going all the way back into the 99. There's a dot-com bubble, 1999, right? Popped in 2000, but wheat has been coming up. So I can see a little more downside. In fact, this has been forever and a day. I haven't updated this chart in a while. You see back here, I had these little dotted lines going down there. What that is, that's a scenario where we could continue to drift a little bit lower. And in doing so is going to see this, we had and still have positive divergence right here at that recent low. But if we can come a little lower, we'll make an actual full tag of the trend line. So yeah, I could see a little, it would look great if we get down there. That's, look what happened if you bought it here, here, here. These were huge runs. This was a 381% rally right there. This one was just to this point 100%. It kept going. I guess I last measured it here. So that would have been well over 100%. So that's it. So we're coming up on long-term secular bull market support with my beloved positive divergence. So yeah, you just got to be patient with wheat right now. The timing, there's no buy signals. We're testing the recent lows. From a longer-term perspective, I think this one is, when I talk about the grim outlook for equities, I'm positive. I think a lot of commodities look good, at least offer much better risk-reward profiles going forward. Now, look, if wheat breaks that secular bull market trend line, takes out the divergence, I'm not going to be talking about going long anymore. But as of now, I think there's still a case to be made. And then corn, they tend to move together. Corn has CORNs, the ETN. You have this nice downtrend line, boom, boom, boom. We need to pop that trend line. We're still all coming off that positive divergence, that divergent low. It's just these grains, they need to break out and start to run. And the charts look like it's going to come. I've been talking about that here. I gave you these long-term targets. I still maintain these targets, but went on, made a new low. We just need to start breaking. The big level we need to break on corn right there is about 1882. And then we need to take out that former T1 level right there, about 2070. And there's maybe a secondary trend line there. So there's your update on the grains. I'm not going to be able to get to the market breadth indicators. I can just tell you that there's still a lot of those flashing some yellow, at least. Sorry, I had a timer going off there. At least yellow, if not red flags, and I'll get to those soon, or I'll just post some charts on the site if I can't do a video on them. The only other things I wanted to cover are the cryptos, Bitcoin, GBTC. I know there's the newer. This one, these were the first to market, Grayscale. I think they trade over the counter. But either way, the charts are similar. I'll get to the actual Bitcoin in a second. Big negative divergences. Nothing remotely close to a sell signal. I'm fully aware that Trump is pro-crypto and all that. But this is we're setting up for the next big down. And personally, not yesterday, it was the day before I started scaling a very small position, only kind of a gut shot trade, because I can tell you there's a trend line I'm going to show you on the futures that we're about to break. I just want to get in front of it. I don't have a lot, and if it just keeps going up, I'll throw the shares, the position away. I use Bitcoin futures. Those are BRR, and I think there's a micro MBT if you want to use the smaller on the futures, or there's plenty of ETFs out there. I can't chart the ETFs because they were only approved recently, and so you don't have the history when you go to Bitcoin ETF. There's a million of them out there now, and you can pick whatever one you want. And some of the more liquid ones, I don't even know. That's an ultra. That's leveraged. Let's see, I've got one here for you. Pro shares, there's BITO. Actually, that one's been around, but I don't know if that's raw. Bitcoin strategy ETF. I don't know what they're going into. So, anyways, I like to use GBTC to chart, and then Bitcoin itself. You can buy the Bitcoin futures, which are BRR. I'm going to get to that one second for you, but let me show you the other ones. BTC right here. Okay, this is the crypto itself. Bitcoin crypto trades on the Paxo exchange through Interactive Brokers. You got the same thing as on GBTC. Big negative divergence. Again, divergence isn't a sell signal, but you've got this little minor uptrend line. This is everyone that bought the Trump pump right there. And so I think a break of that's going to bring you back down to the trend line. I'll use the 60-minute chart. There's a nice support level too. Let me add that right there. If you're looking to get in and you don't want to chase here, maybe you get a pullback to about right here, roughly about 73,000 or so, 73,100. That would be the first level. And you go down to a shorter term chart, you go down to an hourly chart. You can see this is that uptrend line I was talking about right there, and you do have my beloved. And that's what I was liking, this divergence. So I wanted to get in front of that when I saw this divergent high here. So break of that, and there's a big old gap right there. Anyways, I think we'll probably see some profit taking on crypto soon. The other one is Ethereum. You can see Ethereum is also, this is the actual crypto ETH at downtrend line resistance. So that one, there was also an objective case to short there. And so far it's pulled back pretty good. That's a 2-year daily candles on this chart. And this is the first target I have here, about 2,800 right there. So. Okay, just to get back to NVDA, remember I gave you back here recently that one that was stopped out, that trade, but I told you I've been updating. It's still very much like this as a long term, and even a near term short. And here's the setup right there. I'm giving it to you right now. We are on the trend line. That's a beautiful bearish rising wedge, just like I gave you this one here. Boom, boom, boom. We went down, we hit our T3, we covered, we went long on that divergent low. That was also hit at the 200-day moving average, or the uptrend line, primary uptrend line. We did it again there. So this is how, again, I've highlighted many of these trades, maybe not every one of them, maybe all of them. Short there, down to T3, long there, short on the divergent high, wedge break, divergent low, wedge break, long signal, buy signal, the divergent high, pull back there. This one here, threw that as an official trade, and it can maybe, oh yeah, T1 got hit. We did hit T1, so it's not a failed trade. We hit T1, then we exceeded the stop by a small amount. But now, forget about all these. These are old targets, old trades. This is the current trade right here. So there it is for you as I wrap the video up. We are on the trend line now. Break of that trend line. Targets, I think we're going to go on, if I'm right about, you know, where we're at in the market and we're there, we're pushing it, those long-term targets I covered in the beginning of the video would certainly come into play. But right now you could look at these former targets here. I think all makes sense. You'd have actually, that'd be, if you want it, let me see if it's worth shorting. It might not be enough profit-wise. Yeah, 3%. You want a quick T1 right there, 3. And then these targets here. I'd be more apt just to let it run for now, see what happens in the market. Again, with the Nasdaq 100 QQQ at resistance right now, at the previous highs, failed another breakout attempt at a new all highs, rejected at the top of my max market top range. So again, if you play the long game, then you're looking not at these little near-term targets, but you're looking at these targets here. T4 would be $40, and if so, you're talking about a 71% drop in NVDA. Or, you know, you can swing. We already hit T1, so we take out the 200 days, there's going to be a trend change too. So I can tell you right now that if the 200s, if these lows are taken out, yeah, we'll probably have a reaction there, but it will sharply increase the odds that these deeper targets are going to be hit as well, because then we'll be below the 200-day moving averages. We're coming off that big divergent high right here on the weekly chart as well as the daily, and that's it. So yeah, that, and in that, somebody asked me about Tesla too. Yeah, I still very much, even though I threw out a tight stop for you on the last Tesla trade, I think that one's going down with it too. And Tesla's, I still maintain these targets, whether you wanted to use that tight stop I gave you there or not. Still very, very much a very toppy looking stock. And again, it's about being right on the Nasdaq 100. This is not rocket science. If I'm right where the Nasdaq 100 is going, it's not going there without bringing Tesla and NVIDIA and Alphabet and Apple and Meta, all those down with it. They're just, it's due to indexing. It would be almost impossible to see my deeper targets on the Nasdaq 100 get hit and not see all the Mag 7 or Mag 8 also drop 20 to 40%. All right, I'm going to wrap it up here. Long video. In the comment section, if there's anything you want updates on, any trades that I've thrown out or anything you want that I haven't covered, you want my opinion on something, just let me know, and I'll be glad to post a chart or my thoughts if I have any. This has been Randy Finney with Right Side of the Chart. Have a great day.